Good afternoon, everyone, and thank you for taking time to join us today. Welcome to Alpha Credit Advisors, AAA Investor Connect. Volatility seems to be the only asset class delivering consistently last financial year. The past few weeks have reminded us how quickly market sentiments can shift from geopolitical tensions and rising crude prices to continued FII outflows. Investors are once again navigating an environment filled with uncertainty and noise. And in moments like these, the real challenge is not reacting emotionally, but responding with discipline and clarity. That is exactly what today's discussion is about. Understanding the current environment, separating signal from noise, and identifying how investors should think about positioning themselves going forward. To lead us through that conversation, I am delighted to introduce Mr. Rajesh Kothari, founder and managing director of Alpha Credit Advisors. Rajesh brings with him decades of market experience and deeply disciplined investment approach. Today, he will share his perspective on the current oil shock, India's macro resilience, and how investors can navigate this phase of volatility thoughtfully. Welcome, Rajesh.
Thank you. Thank you, Sandeep. Good afternoon, friends. Thank you very much for spending your time for this AAA Investor Connect webinar. And it is our constant effort to make sure that we keep communicating with our investors during all types of market environment. Friends, the recent crisis, particularly the US-Iran war, is of course kind of a little bit disturbing for the across markets, and India is no different. And India being the oil import and oil dependent economy definitely gets what I would say gets impacted more compared to many other markets in the world. Friends, FY26, in fact, if you look at 13-14 months back, from month of February 2026, we are basically entered into, I would say, in an uncertain environment. I remember February 26, which was a time when Donald Trump announced the tariff. Then came Operation Sindoor. Then came a little bit more, I would say, a little bit unfriendly policy, US versus India. And then, of course, came the US-Iran war. So the navigating the volatility is something very, very important. Equity markets are not a straight line. They go up and they go down. So it is very, very important that the portfolio construction, one is of course important part, but second important part is also the behavior, be it a fund manager behavior or be it the investor's behavior. It is something very, very crucial. While we all might think that this US-Iran is something new, in fact, it is not new. If you look at last 20 years, last 30 years, there have been instances in one or other form where the oil went up, where the inflation went up, where the fiscal deficit for certain time, probably was disturbing. But at the end of the day, what is important to realize is that avoid the noise. And that's something very, very important. I'm sure most of you would have experienced that we get, I would say, tons of WhatsApp on everyday basis. We all are at times glued to Twitter, the X handle, to see what Mr. US President would have posted. And at times, the Twitter post at 9 p.m. is different compared to 9 a.m. And there are 4 posts between 9 p.m. and 9 a.m. Now, surely you cannot react to every post. You cannot, decide your emotions and change your investment decision on every post. What is most important is to make sure that you are well guarded. The rail guards is to be extremely strong to make sure that the impact, if any, is very, very limited. You cannot make it zero, but you can mitigate it with a much stronger discipline and with much stronger investment framework. With that, let me directly first straight go into what is our view on the market. And this view on the market, what I'm sharing with you today is, while of course through Zoom it is for the first time, but throughout last 20-25 days, particularly I would say from the last week of March, we have been constantly engaging with our investors, with our partners, with the wealth managers. We have been sending the AAA insights. We have been sending the WhatsApp communications that what is our view. And in fact, last month, in month of February end, when the war started, we came out with a AAA insights And I would briefly also take you through what we have been mentioning about the past cycles, the past drawdown, and the past recovery rate. Friends, equity markets means volatility. Market goes down, but they also come back sharply. So please don't forget it. Let's not extrapolate the best of the scenario and the worst of the scenario. What is important is somewhere in between the scenario, which is reality scenario. And this today's presentation, what I'm going to make is a more unbiased view on how do we look at the market and what investors should do in such volatile conditions. Please give me one moment while I share screen with you. One question which I've been constantly getting, particularly in last 9-10 days, is should I invest today or should I wait? Of course, there are also, I would say, very small portion of investors, they've been also asking, should we redeem? If this war becomes third world war, then what happens? And the one line conclusion to this is discipline over noise and opportunity in volatility. Market, they were volatile, they are volatile, and they will remain volatility. You cannot skip the volatility. But if you consider volatility as your friend, and if you can optimize on that volatility, you can significantly increase the returns over the long term. Give me one moment while I adjust my screen. So if you look at the today's macro environment of India and compare this with the similar bad situation was India has faced, be it a pre-COVID or be it a Russia-Ukraine war. And this is something very, very important because I always keep thinking that what is my downside, correct? Because you can't predict crude oil. Crude oil can become from 60 to 80, 80 to 100, 100 to 120. How much shock you can absorb? How strong our Indian economy shock absorber are? Are they strong or are they weak? An answer to that question decides what is the downside to the market. And few slides, 2 to 3 slides, they are very, very important slides, which I want you to take, to go through it to explain a little bit about the Indian economy. Friends, if you look at pre-COVID, our Indian economy growth, nominal GDP growth was roughly about 9%. And as I speak today, we are roughly about 8.6%. The real GDP growth is still strong, while the nominal GDP growth might have a little bit reduced. But interestingly, the household consumption growth is strong at close to 9%. M3 growth is very strong, double digit, 12.6%. The credit disbursement growth, which shows the underlying demand requirement for the Indian, be it corporate or be it non-corporate, at what rate the banking system is dispersing their credit. And that is a very, very important ticker which helps you to understand what is the underlying demand growth by Indian households or corporate. And that is very strong at 14%. Total liquidity in system is much healthy. It's about 6 trillion. And if you look at inflation, is very, very low, cooling down of inflation throughout last year. And it was like 3.2% in month of, I would say, February. And if you look at the metal price are also being quite strong, about 11%. What this slide is basically telling you, this slide is telling you that pre-war, our Indian economy is on a very, very strong footing. We are not basically entering this war with a very fragile status. We are entered this war with a much stronger position compared to what it used to be, particularly during pre-COVID. You may find that compared to FY22, these numbers are low. But please remember, the FY22 is compared to FY21, and in FY21, there was a 4 months of lockdown. And therefore, your nominal GDP growth, it looks 18.9. Moment you adjust it, it comes down to about 9 to 10%. Let me tell you now the second slide about the external sectors. And this is a segment, I would say, which is a little bit, everybody was focusing very closely that how is India's current account deficit? And India's current account deficit is minus 1.1. It is not very alarming. It is not very, very kind of a red signal. It is a very, very comfortable situation. Exports as a percentage of GDP is also 12%. Again, a reasonably good number. Our imports cover number of months is also 11 months, which is also reasonably good. Interestingly, our service exports is roughly $240 billion, which is a significantly better when you look at compared to FY20, almost 3 times compared to FY20. Of course, the NEFT FTI investment has been the kind of red indicator, which is not so strong. But net, slide number 1 talks about how strong the Indian economy is in terms of the demand, in terms of the credit disbursement, in terms of the cooling down of inflation. Slide number 2 talks about our external sector positioning, be it current account deficit, or be it a number of months of imports cover, or be it a service export, which have been growing extremely strong. Slide 3 talks about pre-war, what has been our fiscal deficit, as well as ability of public sector, both state and center, to spend the capex. And this slide talks about center is doing 3.1% of GDP, state is doing 2.4% of GDP, so roughly about 5.6%. This is a much higher compared to roughly 3.8% during the pre-COVID times. And if you look at the state fiscal deficit and as well as the central fiscal deficit has been reasonably okay, 4.4%. And RBI profit transfer to government, of course, is a huge surplus. Compared to 571, it is almost 3,000 trillion. So again, this slide talks about the ability of the government to spend on capex, which has been going up throughout last 3-4 years in particular. Our fiscal deficit is also contained. The conclusion of these 3 slides are that our Indian economy macros, we are on a much stronger footing compared to what we have been during the previous crisis period. And that means it gives us much more headroom in terms of if there is any crude oil shock beyond what probably Street is currently factoring, then of course it impacts India, but our ability to absorb that shock is much better compared to the previous times. Second most important concern by most investors is that FIs have been constantly selling. While of course DII were buying hugely, but if you look at FY26, just in a matter of 3 months, there is a huge FI selling close to 1,26,000 crores. So that's of course has been one of the biggest concerns, that FIs have been constantly selling, and if they continue to do so, what will happen to Indian markets? Because definitely it creates kind of a natural cap on the upside returns. What is our view on these FIs? Let me explain you in the next slide why we believe that probably we believe there can be reversal of these outflows. From outflows, probably we can move towards inflows. And let me tell you why we think so. And this is a MSCI India price to earning multiple compared to MSCI emerging market price to earning multiple. And if you look at this chart for last 12-13 years, average price to earning multiple is 1.63 times, and we are currently today at 1.35 times. So the valuations are absolutely very comfortable zone, and at this valuation we believe that Indian market now will start looking attractive compared to many other economies in the world. And if the market offers you strong macroeconomics along with the reasonable valuations, in fact at the comfortable lower zone of valuations, then FI selling we believe will reduce from here on. And who knows, probably as the stability comes back, as the war related noise and the crude oil starts flowing the Hormuz and the crude oil price settles, I believe that FI will come back to India because valuations are now very comfortable compared to what it used to be. We did very detailed analysis on what we make out of the valuations. And friends, believe me, irrespective of how much macroeconomics you run, ultimately what is important is what is priced in. And this is not the first time that we have seen this kind of a crude oil crisis or this kind of a war crisis. We have seen Russia-Ukraine war, we have seen before that pre-COVID and many other such incidents. And if you look at last 10-12 years, we have done 2 exercises here. One is based on trailing P and one is based on the forward P. Let me explain this chart a little bit because it might be a little bit technical for a few of you. So this chart talks about at any point of time, if investor would have invested at current valuations, how much was upside, how much was downside? So at current valuation, whenever investor invested in last 10 years, 12 years, the maximum downside is 13%. This chart, as you say, this 13% is your maximum downside. Your median returns, if you hold it for 1 year, as per history, it is 18%. So I repeat my explanation of the chart. If any investor would have invested during last 10 years at a trailing price to earning multiple of 21 times, and if he decided to hold on his investment only for 1 year, then the maximum downside is 13%, maximum upside is 95%, and median returns are 18%. But of course, 1 year is a very short-term window. We all know equity means 3 years. Moment you believe that you have an investment horizon of 3 years, your minimum upside is 17%. Your median returns are 44%. And maximum upside is 124%, roughly about 40% or 38% compounding. So moral of the story is very simple, that on a 3-year time horizon basis, if any investor would have invested based on the trailing P, which is the current valuation as on 31st March, chances that you lose your money is very, 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 very low. The median returns says that you can make 44% median returns, and upside, of course, is 124%. The probability, as I said, is actually zero moment you have a 3 years time horizon if you would have invested at a valuation below 21 times on trailing basis. 100% probability of 0 plus returns. It means 0 probability of losing money. Let me now look at on forward basis. If I invest based on forward 18 times price to earning multiple, then what is my probability of making money or losing money? Friends, this chart is very, very interesting. If you believe that the corporate earnings growth is going to be 15% for FY27, and that means the forward price to earning multiple is below 18 times, there is a almost 99% probability that even on 1 year basis, you don't lose money. On 3 year basis, it's a 100% probability of making money, and the minimum returns are 25%. And across time frames, 1 year, 3 years, and 5 years, the median returns are 22%, 42%, and 50%. So on a compounded basis, roughly 15% compounded annualized returns as a median returns on 3 years basis. Friends, this chart is something very important because ultimately market is nothing but earnings growth and valuation. The valuation becomes the natural support for the market at any point of time, be it a COVID crisis, be it a Russia-Ukraine war crisis, or be it a US-Iran war crisis, or be it a Donald Trump tariff crisis. Time and again, we have seen that once market enter into a very, very comfortable, attractive valuation zone, it discounts the worst case scenario and it starts getting recover, and then it becomes a very speedy recovery. I also get many questions that don't you think this ceasefire may not remain valid? I say yes, ceasefire may not remain valid, but point is not whether it be valid or not. Point is on daily basis, on incremental basis, do you see the bad news from here? So I believe that the peak of uncertainty typically happens in the first 10, 15, 20 days. We have passed that peak of uncertain time. We have passed that peak of the worst news flow time. So I believe that the war may continue for another 3 months, 6 months, 9 months, who knows. But for us, what is important is not to focus on war. For us, what is important is to focus on crude oil price. For us, what is important is whether the crude oil is flowing through Hormuz or not. Please remember, Russia-Ukraine war was also equally big event. And the war is continuing even today. But there is no impact on the wheat exports from Ukraine. There is no impact on crude oil. In fact, the Russian equity markets went up. I don't know how many of you are aware, but Israel stock market, Israel which did attack on Iran, the Israel stock markets are positive. Can you believe this? Israel stock markets are positive. So the important thing is that how to time this market. And to time the market, which is of course, it's not very easy exercise, but if anybody tries to time the market, then you need to time the valuations. And if you try to time the valuation suggests what is your maximum downside, correct? And it also suggests what is your minimum upside. And based on this chart, if we believe this, as per the last 10 years history, as on March 31st valuations, with a 3 years time horizon period, your downside is absolutely very, very, very low. And of course, your median returns varies anywhere between 13 to 16% on compounded basis. So that's one chart which I wanted to little bit take you through in depth. There is another interesting analysis that if you look at the low PE stocks and high PE stocks, contribution to the market, then as you can see here, in January 2024 and also January 2025, the low PE stocks were close to 55%. But today, because of the time correction and the price correction, the low PE and moderate PE stocks, which is below 50, that's basically has gone up from, I would say, roughly 52% to close to 72%. And the elevated PE stock basket is coming down, and that also means that markets are becoming much more reasonable in terms of the valuations. Another interesting question I keep getting is that what if the crude oil becomes 70, 80, 90, 100? So I said, let me put the scenario analysis for all of you. Let me put inflation, fiscal deficit, and current account deficit. And what if you can look at this chart, as you can see here, if crude oil remains $90, the inflation becomes 5%. For every $10, it is 50 bips increase. So let's assume if anybody of you would like to assume that crude oil becomes 100, then what? Then it becomes 5.5. I think 4 to 5 to 5.5% is manageable. Beyond 5.5, of course, that becomes a little bit stress for the economy. What happens to the fiscal deficit? Currently, the government has budgeted 4.3. At 100 crude, we are still 5.1. It is not that deficit is going to become 6.5 or 7.5. We are still 5.1. 70 bips impact is not much impact. It is a manageable. What happens if the current account deficit, to current account deficit if the crude oil goes up? Last year, current account deficit is 1.1%. And if the crude becomes 100, we move to minus 2.3%. Again, it is not a very, very alarming situation. It is a okay situation. Anything above 100 or 105 or 110, I think that's a situation where, the downside can be higher, where it becomes a little bit uncomfortable from the market perspective and of course from the economy perspective. If you ask my personal view, that probability is generally very low. We believe that the war, any war, in terms of the actual crude oil impact and actual economy impact is typically 2 to 3 months and doesn't last beyond that point. So I don't think it is a structural issue. I believe it is a matter of weeks, rather than matter of quarters. And that's something very, very important. Please remember, the Hormuz is flowing the food for the world. Hormuz flows fertilizer for the world. Hormuz flows oil to the world. So if the oil stops, fertilizer stops, urea stops, food stops, entire world collapses. And therefore, the probability of that happening is extremely low, probably below 0.1%. And therefore, I don't think that is a likely scenario. Because moment you enter into such crisis zone, everybody on the planet, be it a US or Russia or China or India or smaller countries or bigger countries or NATO and Europe and Iran and Iraq, everybody will come together and they will try to resolve, because if they don't resolve, then anyway, the world will stop. Am I right? And nobody wants the world to stop, be it US or be it China or be it Europe or be it even Iran and the Middle East countries. So I think it is a temporary problem. It is not a structural problem. Definitely, temporary problem creates a volatility. It disturbs the economies, no doubt about it. But as an equity investor, what we all need to keep an eye on, how long this problem can persist. Is it a matter of 1 month or is it a matter of 1 year? Nobody knows by when what happens, but what is getting priced in? If I'm buying the companies below 20 times price to earning multiple on trailing basis, the valuation, the margin of safety is in my favor. If I'm buying anything below 18 times on 1 year forward basis, the margin of safety, the valuation is in my favor. And that's a time where a smart investor starts allocating more to equity as an asset class. This is a slide again is interesting. As I was telling you that this is not the first time we have seen multiple war zones. And here I'm basically plotting the 10 events, including the current event. And these are AAA insights in month of February. And very interestingly, if you look at this, each of this, the red denotes how much market went down. Green denotes how much market went up. And I've also mentioned the decline during every time. And I also mentioned the number of days to recover. The average drawdown during war is 10%. The maximum drawdown was 22%, but that was 9/11 attack. And that's different. 9/11 is different and US-Iran is different in my view. And if you look at the recovery time, 38 days from the bottom and maximum was 49 days. Now look at the beauty of this past history. Average drawdown is 10%. And actually, if you look at US-Iran war, when market went down 11%, it made a bottom. Exactly actually in line with what we talked in our AAA insights, that average drawdown is 10% and this war is not 9/11, and therefore anywhere between 9 to 13, 14% market should bottom. And that's what exactly happened. At 11%, market did its first bottom. And then market, of course, started recovering. And of course, there's a good news from the US and Iran, ceasefire and so on and so forth. So from that point, market has already started going up. Let's hope that the past experience of 38 days on average, market recovers. That's a history. Let's see what happens this time. I'm not an astrologer, so can't predict how many days it will take. But history suggests that maximum is 49 days. And these are the opportunities. Whenever market gives you such opportunities, capitalize on these opportunities. Don't be in a panic mode. World is not going to stop. You just need to stop your Twitter. You just need to stop sometimes the media channels, sometimes the news. Most of these news are as per sources. The sources 99% of the time are less reliable because they keep changing their sources. And you can't take your portfolio action based on sources by any news channel. So at times, I always tell all my investors and my friends that please close down all your TV channels, stop reading newspapers, just invest and look after 2-3 years. Things are going to be much better compared to what we have seen throughout that very volatile time. That was our advice during COVID time. That was our advice during the Russia-Ukraine war time. That was our advice during Donald Trump tariff time, and that remains our advice even during the US-Iran war times. And believe me, friends, it pays off handsomely. What we are doing and what it means, how basically, the conclusions of this. So first, as I said, the oil shock is fundamentally different from a structural one. This is not a structural oil shock. There is enough of crude oil supply in the world. Unlike earlier stress scenario, our macros are much stronger today. We are in a much better position to handle this crisis. Public capex has scaled up rapidly in last 4 years, and therefore domestic growth momentum pre-war was very strong, particularly after GST cut. If you look at the automobile growth, if you look at the credit disbursement growth, if you look at the credit card spend growth, if you look at the two-wheeler volume growth, if you look at passenger car volume growth, they have been very, very robust. We have a far greater ability, therefore, to absorb such shock and mitigate the impact. What if the crude oil goes 100 plus for a longer period? We believe up to 100, we are reasonably well stable. I don't see any major problem. If it crosses 100 plus, and if it sustains that, not for 1 day, 2 days, 3 days, but for a few months and few quarters, then Indian situation becomes a little bit negative and we get impact adversely. Whether FI selling will continue? Well, I don't think so, because ultimately they also look at valuations, and valuations right now shows that we are at a very, very comfortable level. Will FI start buying tomorrow? I don't think so. Probably they might wait for maybe few weeks till the time the oil settles. What are the valuations suggesting? What is the ultimate guide to any investor? The valuation suggests that margin of safety is in our favor. Whenever I meet many investors and many partners, they all get inspired by Warren Buffett. And crisis like this, I would advise every investor to probably remind themselves that what they've read about Warren Buffett, we also need to experiment and experience and behave like that. That margin of safety, whenever is in your favor, that's the time to increase the allocation to equity. So the answer to the question, should I wait or should I buy? Should I wait or should I buy today? Answer to the question is, depending upon equity allocation. If your equity allocation is very low, surely you should increase your equity allocation today. If you are a very, very conservative investor, maybe you can stagger over a period of 2-3 months because you want to see more, certainty, more peace of mind. But please remember one thing, that good price and good news never come together. If you are waiting for good news, you need to pay price for certainty. The risk premium, what you are paying for, you have to pay because you want to wait for everything to become green. And once everything is green, prices are also going to be green. The valuations are also going to be green. So you need to be very clear that if everything is green, then what I will do. So, there are investors, they hold on huge level of cash and they say that, okay, I would invest once the entire war settles and Hormuz becomes pre-war situation. Nothing wrong about it, but at that point of time, if the market goes up back to 26,000 levels on that day of the newspaper when everything is normal, what you will do at that point in time, if you again think that now I cannot invest, then you actually miss the entire story, the entire burst of Indian economic growth story. So I have seen, throughout my experience with interactions of many investors, that they keep waiting and they miss the bus totally. To avoid that, I advise do the staggered approach. Maybe 30, 40, 50% you invest, over a period of 10, 20 days, and another 30, 40, 50% you invest over a period of 2-3 months. That probably offers peace of mind to many investors. We have a very good STP option, systematic transfer plan option in our PMS, and of course the top-up option for our AIF. So we recommend investors to use that if you are very conservative. For investors who have seen the tough times of the market in last 12, 13, 14 years, this is a time to do investment lump sum. Downside, maybe 7, 8, 9, 10%. But if you have a real long-term view, you will still definitely make very strong wealth creation over a period of 5 to 10 years. Nobody knows what will be the peak of crude. Nobody knows what will happen Donald Trump tomorrow and will he stick to it day after tomorrow. Nobody knows that. So there is no point of predicting every step. You just need to keep focusing on how you will create wealth over next 5 years. And if that returns are going to be significantly higher compared to fixed income or gold and silver, then that's the time you need to invest. Lastly, how we are navigating this volatility. So as you are aware that we believe in a 3M investment approach: market size, market share, and margin of safety. Friends, it's very difficult to predict when the storm will come. And therefore, I always believe that we have to be ready 24/7. That what if the storm comes right now? Because when the storm comes, you can't prepare yourself on that day. We need to be ready 24/7. We need to have bulletproof jackets 24/7. And 3M, market size, market share, and margin of safety, is our bulletproof jacket to ensure that we get hit minimum in such adverse economic situation. If the crude oil goes up, inflation goes up. If the crude oil goes up, if the inflation goes up, the interest rate goes up. And if the interest rate goes up, which company will be hit the most? The companies which are high debt equity, they have high borrowings, they get impacted the most. And therefore, in our portfolios, across our PMS and AIF, across all of our products, we do not buy companies which have high leverage. We buy only companies which are either debt-free or they have a very low debt equity ratio, probably 0.2, 0.3, 0.4, certainly below 1 time. So when we buy businesses with the under-leveraged balance sheet, the cash-rich companies, if the inflation goes up, if the interest rate goes up, they do not get adversely impacted. In fact, they get positively impacted because high debt वाली जो company होती है, वो bankrupt हो जाती है, and therefore they close down, and hence our companies which are cash-rich companies, their market share actually goes up. So we buy the companies which are market leaders. That's very, very important. We buy the companies which are under leveraged balance sheet. That's very, very important. Few weeks back, when the crude oil is going up, everybody was worried that this will lead to increase in cost. Now, if the cost increase happens, margins definitely goes down. But if the company is market leader, then they will increase the price. For example, Mercedes-Benz announced the 2.5% price hike in the last week of March itself, because they know that a consumer who is buying the Mercedes-Benz of 1.2 crores, he won't mind paying 2.5% extra cost. However, as one of the largest two-wheeler company, which is selling the motorcycle at 45,000 rupees and 50,000 rupees, they cannot do 2.5 or 3% price increase. Because if they increase the price by 3, 4, 5%, probably consumer may not buy his product. So it is very, very important to make sure that if you buy the companies which are market leaders, they enjoy the pricing power. And if a company enjoys the pricing power, then your ability to pass on that cost increase to your consumers. And when you pass on that cost increase to your consumers, your margins remains intact, and therefore there is a very, very low negligible impact on your profit growth. At Alpha Accurate Advisors, we buy companies which are market leaders. Many of our portfolio companies, they are oligopolies. Many of them are monopolies. And oligopolies and monopolies, it means pricing power. It means ability to pass on the cost increase to your end consumer. So this second very important thing, buying the debt-free balance sheet with a very strong market leadership that helps you to navigate the external shock. Third, of course, very important is our agile style, quality plus agility. Discipline exit strategy is hallmark of Alpha Accurate Advisors, and we keep doing it constantly to make sure that our portfolio companies are relevant for the high growth during the next 12 to 18 to 24 months. Very important, what kind of sectors which we should avoid and what kind of sectors which we should buy. Friends, we have a zero exposure to oil marketing companies and zero exposure to aviation. These are the two most impacted sectors whenever the crude oil goes up, and we have a zero exposure to the sector, not today, but for last 16.5 years. We are not invested in oil marketing companies and aviation. What we like today, we continue to like sectors like automobile and auto ancillaries. Why we like this sector? Because we believe there is a premiumization as a trend, more content per vehicle, and the cut in GST done by government will lead to the strong consumption, particularly on the discretionary side, which includes even the automobiles. Second, what we like is the consumer-oriented business, particularly the discretionary side of consumer, because we believe that the rise in per capita income and also the cut in GST will influence the aspirational consumer to upgrade, and therefore be it apparel, be it a organized retail, or be it a building material, these segments will likely to be beneficiary. We also like banking and financial because of the very strong asset quality. At the same time, we believe that the net interest margin, which came under pressure in FY26, will reverse in FY27. Capital goods, we continue to like this sector. We have been early entrant in this space in 2019, 2020, 21, and it has been a huge rewarding for us. and we continue to like this sector. And of course, we also like select hospitals and select platform companies. How we have performed during this downtime, and let me start with AAA budding beast. This is not the first time we have seen such kind of a drawdown in the market. As you can see here, mid and small cap went down significantly even during the Russia-Ukraine war. Small cap index went down 27%, but our fall was only 19%, by and large in line with BSE 500. After that, mid and small cap went through a rise, and as you can see here, BSE 500 went up 32%, Nifty small cap went up 48%, and our budding beast went up 51%. So fall less during bad time, rise more during good times. And then again, last 18 months, there was a serious price and time correction where small cap index went down by 23%. And against that 23%, our budding beast, that is the mid and small cap PMS, went down only 14.5%. Again, protecting the capital. And this is something very, very important. Throughout last 16 years, even our IOP portfolio strategy has consistently outperformed, particularly during the down times of the market, to ensure that we first meet our objective of protect capital first, and then of course create wealth. So that's about in terms of our market outlook. Just to conclude, from market perspective, we are reasonably bullish on the market. We believe that the valuations are a very comfortable zone. We believe that the Indian macros are in a much stronger wicket compared to what we have seen throughout last 10, 12, 15 years as far as our Indian macroeconomic situation suggests. FII flows, we believe, is likely to, we are going to see probably less outflow, and at some point of time, we will start seeing the inflows. In terms of the equity allocation, as I said and I reiterate, that we believe that the long-term story of India equity is intact, and any downside from here, probably one should use as an opportunity to keep adding to equity as an asset class. With that, let me also probably in 3-4 minutes cover one important question which I keep hearing, that should we buy mid and small cap or should we buy large cap? And just to put it very, very briefly, there is a common perception that large caps are safe, mid and small cap are vulnerable, and they are expensive, but they are actually not. And reason why I say so is I just want to give you one important highlight, that today's mid and small cap debt equity has become zero. Their resilience have gone up tremendously. And when the resilience increases, when that improves, what happens? Your ability to survive goes up. And when you survive the downturn, you participate fully during the upturn. If you look at the transformation of mid and small cap in last 13, 14 years, the average weighted market cap of mid cap has now increased to 60,000 crores. Average weighted market cap of small cap is 17,000 crores. They are no more small. They are actually giants. Their profit size is 1,000 crores. To give you a perspective, there are only 800 companies in India which makes 100 crores plus profit. So the median profit size of Nifty mid cap index is 1,000 crores. These companies are really big. They are giants. In small cap also, the profit size is 400 crores. They are actually giants. The ROE of mid and small cap is now actually equivalent to almost large cap. The debt equity is also equal to large cap. It has become zero debt equity. And of course, the growth is very, very fast. And therefore, I believe that the mid and small cap space is right space to be in to create long-term alpha for the investors. To clarify our definition of mid and small, we go by SEBI definition. Top 100 by market cap is called large cap. And then from 100 to 1,000, in my view, is the right space where we keep focusing and look from the opportunities perspective. Beyond 1,000, 1,200 companies are actually micro cap. So we divide 3 segments, 0 to 100 large cap, 100 to 1,100, that's basically mid and small cap, and anything above 1,100 to 5,000 is actually a micro cap and nano cap. So that's the space of micro cap and nano cap on which we are not very positive, but we are extremely bullish on 100 to 1,000 or 100 to 1,100 companies. And this is basically the universe which we keep focusing. In terms of quick update on AAA budding beast, as you are aware, in mid and small cap space, we have two products. One is our AAA Budding Beast PMS, and second is AAA GEMS AIF. Friends, AAA Budding Beast, as you are aware, it offers the strength of large with growth of mid and small. Let me quickly take you through our current portfolio and sectoral holdings. So we are remain bullish on banking and finance. We are 17% into banking, 17% into consumer. Capital goods is 14%. Pharma is 13%. Auto and auto ancillary is roughly 12%. Chemicals is 6%. Software platforms are 2%, and others are roughly 8%. This is a 50 stocks portfolio, 50 stocks portfolio. Each of the company is market leader. AAA Budding Beast PMS is probably India's only mid and small cap PMS, which is called mid and small, but we do not invest into any small company by revenue size or any small company by profit size. We buy companies which are market leaders irrespective of their market cap. We have identified 40 to 50 sectors in India where there are only handful of players in the industry, which makes them oligopolies, which makes them monopolies. And when you buy oligopolies with a better pricing power, zero leverage, high ROE, naturally it offers very, very strong moat, and that helps you to reduce your drawdown. We buy only if there is a growth to ensure that there is a wealth creation. And once we buy, the agility comes into play. We keep monitoring business cycles and keep exiting companies depending upon our outlook on valuation and growth. How these portfolio companies in terms of actual numbers, our average weighted market cap is roughly 45,000 crores, 42,000 crores, quite significantly large compared to probably most of our peer groups. Our portfolio companies, most of them are 100 crores plus profit making. They are under leveraged. Many of them are debt free. And very importantly, they have a very strong 24% earnings growth. How this portfolio is delivered in financial terms for the third quarter? Compared to Indian economy revenue growth and profit growth of BSE 500 of 12% and 14%, our portfolio delivered very strong, robust growth of 28% revenue growth and 30% profit growth. How is our portfolio in terms of valuation? Our portfolio offers 1.1 PEG, which is equivalent to Nifty, but much better and stronger growth of 31% with a much higher ROE and much stronger balance sheet. And it is trading at roughly 1.1 time PEG, which in my view is extremely attractive. How we keep changing our portfolio, and we keep showing this slide. So every year we keep seeing that where do we see the growth, and based on that we keep changing our sectoral outlook. To give you one example, we have been underweight IT sector for a very long time, and post Donald Trump Indian IT related policies, we made almost close to very, very negligible. Only 1% of our portfolio is IT. If you look at automobile, we have been increasing our weight. Post GST, we increased it further. And if you look at auto index, is also up 11%. Specialty chemical is one space. After exiting completely in March 2023-24, we again increased our holding, and our key holding has been Navin Fluorine, which have done extremely well throughout last 18 months. Capital goods is one space which we have been very positive. We have been doing some profit booking because sector is going through multiple re-rating. Currently, we continue to hold 14% of the portfolio. One of our large holding is a very unique company into HVDC transformer, company called Hitachi Energy. We identified 3,300 rupees, and stock went up almost 8 times in less than 2.5, 3 years. All these examples, what I'm saying here, it is not a recommendation. We keep doing buying and we also sell. So these are not a recommendation. This I'm just giving as an illustration of our examples. So causality is something important. Exit strategy is something critical. How we have performed in terms of performance during last 1 year? Over 1 year, compared to BSE 500, which went down 3%, our portfolio delivered positive 3.3%. It has delivered very strong alpha of 6.4% on 1 year basis, 8% on 2 years basis, close to 7.5% on 3 years basis, and 9% on 5 years basis, and also 9% on 15 years basis. 15 years is the attribution of our multi-cap. Interestingly, beta of this portfolio is less than 1. This is very important. The beta of the portfolio is less than BSE 500. Our portfolio is mid and small cap, and beta is less than BSE 500. So consistently on 3 year, 5 years and long term basis, 20% compounded returns with beta of less than 1 again shows proof in the pudding that superior risk adjusted returns. This is a year-wise performance. As you can see here, across the time frames, we have delivered, 5 out of 5 years, we have delivered very strong alpha to our investors. Rolling returns, something very important for family offices. Our AAA budding business consistently deliver 24%, 29%, and 23% rolling returns on 5 years, 3 years, and 1 year basis. Coming to 2 minutes on AAA GEMS Fund. This is a very recent product offering in AIF format. It is a category 3, open-ended with a weekly NAV option and no lock-in period. AAA GEMS Fund is a 30 stocks portfolio within mid and small cap. Our investment philosophy remains the same. Our investment process and stock selection approach remains the same. We buy market leaders, just like I talked about in our other investment philosophies. Everything else remains the same. This is broadly the sectoral allocation. We have been under deployment mode, so some amount of cash was also kept because the volatility was very high and uncertainty was also very high. So we were sitting on some level of cash, particularly in February and March period. This portfolio also offers 29% earnings growth, and this portfolio also offers PEG of 1 time compared to Nifty PEG of 1.1. Coming to our flagship multi-cap, AAA India Opportunity PMS, quickly going through the sectoral allocation. We remain positive on banking and finance, auto and automobiles, capital goods, pharma, consumer is 8%. Software we have been underweight because of the issues, particularly on AI related issues and earlier issues of the H1B visa related issues. So this is our sectoral allocation. In terms of the market cap allocation, we are 60% large cap, 17% mid cap, and 17% small cap. This portfolio again offers very strong growth, 21% growth. Most of these portfolio companies are under leverage and they enjoy high ROE. How our portfolio is performed in third quarter? It has delivered very strong 21% revenue growth and 18% profit growth compared to BSE 500 revenue growth of 12% and 14%. What is the portfolio valuation? It trades at typically 1.1 PEG with a 24% EPS growth. This is the slide where we talked about how we keep changing our portfolio and sectoral weightages. And just like I've shown one example in Budding Beast, we keep changing our portfolio depending upon business cycles. So we monitor business cycles very closely. We identify every sector and stock based on its business cycle. We identify it, capture the upside and get out of it and try to identify something else. Where do we see the business cycle is going to be on upturn? As I was saying, we have seen many volatile times, and 16 out of 18 volatile periods, AAA IOP has outperformed the BSE 500 during most of the times during the down times of the market. If you look at this AAA IOP, on 15 years, it has delivered 17% compounded annualized returns compared to benchmark returns of 11.6%. And on 2 years, 3 years, and 5 years basis, it's delivered 3.4%, 13.2%, and 12.4% compounded annualized returns. The last year, our IOP delivered -5.3 compared to BSE 500 -3.1. The reason, part of reason why a little bit underperform is one, we have been a little bit overweight in the first 6 months on pharmaceuticals because that was a tariff situation where situation was extremely uncertain and all cyclical stocks, they were more, I would say, adverse impact of tariff compared to pharma. And in fact, Donald Trump also exempted Indian pharma companies from the tariffs. But irrespective of that, the narratives were very strong and pharma stocks also took beating. Of course, we changed our portfolio post-September GST cut and we reduced our pharma holding and we moved to automobile and we increased our exposure to banking, which were otherwise in a slowdown mode. And that started having a positive impact in terms of portfolio performance in last 3, 4, 5 months. These are year-wise performance. The rolling returns very strong, 16%, 18%, and 20% rolling returns on 1 year, 3 years, and 5 years basis. As you are aware, We also have a multi-cap AAA India equity fund, which is a category 3 open-ended, no lock-in period, weekly NAV option, AIF, and just like AAA IOP, it also has a similar, something very similar performance with a high consistency in terms of the performance. So that's it from my side, and with that, I think we can open up for Q&A. I took a little bit longer because the market situation and a lot of questions which I already got before the conference. I thought to address as many questions as possible to preempt the question, and with that, probably we can open up for question and answer. Thank you very much once again to all the investors for hearing us very patiently.